Hi, in this video, I'm going to talk about how do you keep your wealth safe. My name is Gary Mishers. I'm the Managing Partner and Chief Investment Officer of Silver Ring Value Partners. I also teach the Value Investing Seminar at the FW Olin Graduate School of Business. So how do you keep your wealth safe, especially in this environment, which right now I think is pretty dangerous as far as potential for losing money? Well, there are three things. First, I think you should follow a process. Second, you want to make sure to keep an eye on alignment. And third, you want to keep an eye out for extremes. And I'll walk you through all three and what they mean. So as far as process, it can be as simple as, hey, I know I can't beat the market. I'm going to buy a low cost index fund and I'm going to dollar cost average, which means that every month or every quarter, I'm going to buy the same amount of dollars in that fund. That's perfectly fine. I think, as a matter of fact, for most people, it's probably the best solution if they know they can't do better than that. But it's a process. It's something they're going to do repeatedly, regardless of the external environment. For a bottom-up value investor like myself, it's more complicated. There are checklists I use and there's steps I use. But regardless, the important thing is that you have a process that's well thought out, that's appropriate for your circumstances, that you follow consistently time and again. That's number one, follow a process. Number two is look for alignment. So going back to that low cost index fund example, the alignment is pretty good. So if you're giving money to Vanguard, they're a mutual company, so they're not trying to make the most money off of you. They're trying to provide a service at the lowest possible cost while keeping the quality high. That's a good degree of alignment. On the other hand, let's say you hand over your money to a typical hedge fund. Well, the alignment there, not so great. The fee structure is set up in a way that if they do really well for you, they do really well. That's good. And if they do not that great for you, they still do pretty well, which is great for them, but not for you. So, I would say keep an eye on alignment, because I think it's important that the way you invest in money is aligned with your goals, and that it's not, the opposite of alignment where someone can do very well and you might not do very well as an investor. So that's number two. Make sure there's alignment in the way you invest. And finally, and especially pertinent in the current environment, is keep an eye out for extremes. So what do I mean by that? So you want to keep out for extremes, both in terms of things that are extremely crazy, in terms of things not to do, and things that are extremely potentially undervalued and distressed. So let's start with things that are extremely crazy. So right now, one thing that's extremely crazy is the negative bond rates in some European credit markets. So if you go to Switzerland or some market like that, you're actually paying the government for the privilege of lending the money. That is crazy. That is absolutely crazy. And the reason it's crazy is that these people, it's not that they expect deflation, they still expect inflation, meaning they're voluntarily giving $100 today for the privilege of receiving maybe $80 or $90 in purchasing power in 10 years. That makes no sense. That's not an investment. And you want to keep an eye out for things like that, because that's completely irrational. And there are probably a whole bunch of other things tied off of that. They're also pretty irrational. Maybe some fairly questionable credit companies with junk credit receiving very low rates because the government rates are so low and so forth. So what you want to make sure you don't follow the crowd and say, well, everyone's doing it. Everyone's giving money to the government at minus 0.5%. So I'm going to do that too. No, that's silly. Don't do things because other people do it. Do things because you understand from first principles why you should do it. Well, on the flip side is, you should look at, are there areas of, the market where everyone's or almost everyone has left and they're in distress? Capital is going out. People don't like it anymore. It's not popular. Currently there happens to be value investing, which is what I do, and I think that's great, because I think right now there are some, a few, but not, 100, but there are some good values out there that are not being recognized by the market, and it's a market that overall is rewarding stories and high growth rates. And if you say that you're a software as a service or SaaS company, you automatically get to trade at 10 times revenue or something like that, while as in some other mundane businesses, there are companies trading for less than 10 times free cash flow. So when you have these kind of extremes, you don't necessarily want to automatically invest there, but you at least want to identify that as an area to look through carefully and look for opportunities. So hopefully these three things were helpful. So number one is follow a process. Number two is make sure there's alignment in the way you invest. And number three is look for both extremes of overvaluation and extremes of potential undervaluation in areas that have been largely abandoned by other market participants. If this video has been helpful to you, please hit like and subscribe to my YouTube channel. Thank you.